Hello, my friends. Today is June 3rd. My name is Joseph, and this is Markets Weekly. This week, we're going to talk about three things. First, we'll talk about lifting the debt ceiling and its economic implications. Secondly, we'll talk about replenishing the Treasury general account and how it might impact markets. And lastly, we'll talk about the Fed skip, how it's very likely, but not yet a done deal. Okay. Starting with the debt ceiling. As we all know, the debt ceiling was raised, to no one's surprise. As usual, there was some drama, but at the very last moment, there was a compromise, the debt ceiling was raised, and everything went back to normal. Now, going into the debt ceiling episode, my greatest concern was that it might result in a compromise with sizable federal spending cuts. If that were the case, then that could mean that the US could drift into recession later on in the year. After all, less federal spending means less demand in the economy. To my surprise, the debt ceiling compromise actually involves very little in terms of spending cuts. What was most noteworthy was that student loan repayments are resuming. So in the US, oftentimes students borrow a lot of money to attend university because university is very expensive. Overall, there's about $1.6 trillion in student debt outstanding. There's about 40-some million people with student debt loans. The typical monthly payment is about, say, $400 a month. Now, over the past few years, the government suspended payments on student loans as part of their COVID stimulus measures. So over the past few years, student loan borrowers didn't have to repay their debt. But starting in September, they're going to have to start paying again. And that means that each month, those 47 million borrowers are going to have to set aside a few $100s a month to make their student loan payments. That's money that could have otherwise been spent on restaurants or buying random stuff or buying stocks and so forth. So it's going to have a mild drag on the economy. But the bigger picture is that there wasn't any meaningful reduction in the federal deficit. Now, at the moment, the federal deficit is projected to be about $1.5 trillion this year, and the Congressional Budget Office estimates it to be about 1.5 to 2 trillion, basically forever, based on current law. Now, this is a really different world than how things were just 20 or 30 years ago. 20 or 30 years ago, we had many people worried about the deficit and trying to run a balanced budget. But there's a big cultural shift in how Congress approaches this now. So everyone is very comfortable with large deficits. And it makes sense from a politician perspective because in order to get elected, politicians have to promise people free stuff. Now, that could be free money or free services to the general public, or it could be tax breaks or federal contracts to big corporations. That's just the path of least resistance. It's also a path to a decade of high inflation. At a high level, you can think about deficit spending as, say, buying goods and services, but paying for it by printing a treasury security. If you do that a lot, as we did in, let's say, 2020, you get inflation. And we continue to have this inflationary drive of deficit spending. Now, if anything is for sure, it seems like that estimate from the Congressional Budget Office is likely an underestimate because it's based on current law. If over the past few years, there's always new spending bills every year that continues to add to government spending. So the deficit over the next coming years is likely a lot higher than, let's say, 2 trillion a year. And that is core to my thesis of a decade of high inflation. Okay. Now let's talk about the second topic, rebuilding the Treasury general account. Now, after the debt ceiling is raised, the Treasury has a lot of room to issue a lot of Treasury securities. One of the first things it wants to do is to top up its checking account. The Treasury, like everyone else, has a checking account. It's at the Federal Reserve instead of a commercial bank, and it's called the Treasury general account. Now, today it has about, let's say, $27 billion in that account. It's really low. It's telling us that it wants to refill that account to about $550 billion by the end of June and $600 billion by the end of September. Those are its targets that it's guided towards. They're not set in stone, but that's what it wants to do. So that means that it has to source about $500 billion of cash to go into its Treasury general account. That means that someone somewhere in the financial system is going to lose $500 or so billion of cash because it's going to go out of their account into the Treasury general account. Now, there are two sources of cash to refill the Treasury general account. One is it could come from the reverse repo facility, which you can think of as just this huge pool of excess liquidity in the financial system as a result of quantitative easing, or it could come out of cash held in the banking system. And where the cash comes from to refill the Treasury general account depends on who buys the newly issued treasuries. So let's say that the US Treasury issued $1,000 in Treasury securities. If it were bought by a money market fund, what the money market fund would do is it would withdraw money out of the reverse repo facility and use it to buy the Treasury securities. Money then would flow out of the reverse repo facility and into the Treasury general account. That's case one. Now, case two is suppose an investor like you and me went and bought $1,000 in Treasury securities. We'd have to pay for that with money we hold in the commercial banks, and so money would flow out of the commercial banking sector and into the Treasury general account. Now, these two are commonly thought of having different market implications, because when you're taking money out of the reverse repo facility, you're taking basically money that no one really needs. It's just kind of a huge wad of excess cash as a legacy from large quantitative easing. But when you're taking money out of the banking system, well, that means that the investor community basically has less cash. Let's say that you are a big institutional investor and you purchased $1 billion worth of Treasury securities. That means you have $1 billion less cash, and in exchange, you have $1 billion more in Treasury securities. In a sense, rebuilding the TGA can be thought of as a type of quantitative tightening. Less cash in the financial system, more Treasury securities. The way that I like to think about the impact of QT and QE is that when you have QE, you flood the financial system with a lot of cash, and someone somewhere says, I don't want to hold all this cash. Instead, I want to hold more stocks, more bonds, or higher yielding treasuries. After all, cash gives me a yield of 0, and there's some counterparty risk because the bank could default. So the more cash I have, the more I have demand for financial assets. Now, QT works in the opposite. It takes cash out of the financial system and replaces them with treasuries. And when you think of it that way, that means you have investors who have less cash and are instead holding Treasury securities. So they have less of a demand to buy other financial assets because they're receiving some yield on their Treasury securities, and it's a safe asset. Now, of case A or case B, I think it's more likely that the TGA rebuild will actually come out of cash held in the banking sector. This is because at the moment, bill yields are just not very attractive to the money market funds. They can earn more money just by keeping cash in the reverse repo facility. Over time, this is going to change because the US Treasury is going to issue a lot of bills, and eventually the supply of bills will be so high that the bill yield will rise and money market funds will want to buy them. But I think that's sometime in the future. So what's most likely, in my view, is that over the next, say, 2 months, you have a significant drain of cash held in banks, out of the banks and into the Treasury general account. And that, I think that will be a headwind for our financial assets. How much a headwind, though, is hard to say because asset prices are in part psychological. You have this mechanical rebalancing impact that's going to be a headwind, but you also don't really know what investor beliefs are. I mean, look at what's happening in the market this past week. A lot of people believe that AI is the future, and so they're buying a lot of AI stocks. At the moment, it sounds like there's a lot of people who believe that this Treasury liquidity drain is going to have an impact on market prices. So again, it's going to be a headwind in the next 2 months. Okay, the next topic and the final topic I'll talk about today is the Fed skip. Now, as we discussed last week, Governor Waller, a voting member on the FOMC, gave his outlook for the June FOMC. He says there are three options. One, we don't hike and we tell everyone that we are at the terminal rates. We're going to keep rates at around 5% for the rest of the year. He says that he's really not in that camp and he thinks that's really unlikely. What he is saying, though, is that he thinks two other paths are more likely. One is that they hike in June, and two is that they don't hike in June and instead hike in July. That is to say, they skip. Now, Governor Waller suggested that he's in the camp of either hiking in June or skipping and hiking in July. Once he made that speech, the market began to price in more of a probability of a June rate hike. When I say the market, I'm looking at SOFR futures, which you can see at the CME's website. It's public. Now, this past week, we had someone else who was also important, future Vice Chair Jefferson, give a speech and say that he is in the skip camp. That is to say, he doesn't want to hike in June, but he's open to hiking in July. Now, when he said that, the market began to think that, the Fed is not going to hike in June. Maybe they'll hike in July. But after he said that, note that we also had really hot unemployment data. The Friday non-farm payroll data came in higher than expected, and the prior two reports were also revised higher. Now that sends a message that the economy is doing better than expected. Now the Friday payrolls report also showed that the unemployment rate ticked a bit higher, but I think the overall picture over the past few months is a U.S. economy that continues to chug along and create jobs. Now, the Fed, being that they're data dependent, well, they have to look at this and have more of a probability of a June rate hike. So, in my view, a June hike is still possible, though not the base case, simply because Jefferson made such a strong stand in favor of a skip. But between now and then, there's a couple more things to watch. Right before the FOMC conclusion right before the conclusion of the June FOMC meeting, the FOMC is going to get a glimpse of CPI. And so if CPI is really hot, in conjunction with a strong non-farm payroll report we had this week, I think that makes a pretty compelling case to hike in June. On top of that, one of the things that the Fed watches is asset prices. So monetary policy works in many different ways, but one of the ways it works is by reducing asset prices. So if you have, let's say if the stock market goes down, then people have less wealth, they're less likely to be spending on goods and services, and that cools the economy. Over the past 2 weeks, we've seen the stock market basically rocket higher, up basically every day, and perhaps that will continue, I don't know. But if you're the Fed and you're seeing strong jobs data, strong asset prices, and maybe even higher than expected inflation, which we don't know until the CPI is out, then you kind of have to be in the hike camp. So June, in my view, is not necessarily a skip. However, though, if they do skip, there's also ways the Fed can communicate a hawkish skip, because June is one of those meetings where the Fed will reveal a new dot plot. A dot plot is a way for Fed FOMC members to show what their forecast is for rates and inflation and unemployment over the next few years. If the Fed were to skip in June, they can easily show a more aggressive dot plot there where they guide towards a higher terminal rate. So although they could skip in June, they could still make a hawkish message by having a hawkish dot plot. So I think what it comes down to will really be CPI and how the stock market performs over the next few weeks. Okay, so that's all I've prepared for today. Thanks so much for tuning in. If you like what I'm producing, please remember to like and subscribe. And if you're interested in learning more about the financial markets, check out my free courses at centralbanking101.com. Links will be in the description below. Talk to you all next week.